A very good morning to Madam Sawa and my fellow friends. Today, me and my friends would like to present to you guys about Chapter 8 of FIN435 Banking Products and Services. These presentation slides are prepared by Rafhan Amir bin Henrickson Jeremy, and Mohd Yaziid bin Mokhtar and Brandther. So Rafhan Amir, the first presenter, will cover on the deposits and remittances. Meanwhile, Henrickson Jeremy, myself, would cover on the credit facilities, and Mohd Yaziid will cover on the customer products, corporate products. Meanwhile, Brandther will cover on the internet banking and futures of active products. Okay, let's start.
Hello everyone, my name is Rafhan Amir and today I will present about deposit. Deposit is the placement of excess funds by the surplus unit in the financial system for the purpose of either investment or temporary placement. It can be divided into demand deposit or other deposit. Demand deposit is funds placed in the current account maintained by individuals or corporate customer. And other deposit is placement of funds in saving accounts, fixed deposit accounts, or investment account. There are four types of deposit products, which is saving account, current account, fixed deposit accounts, and negotiable instruments of deposit (NID). First one is saving account. Saving account is the interest-bearing savings deposit provided by banks. Interests are calculated daily and the payments are credited to saving accounts semi-annually or sometimes monthly. Saving account can open for individual, joint, trustees, societies, associations, and institutions. Savers are given passbook or statements, but nowadays commercial banks will issue statements rather than passbooks. The depositors can also get their statements online via the internet. Savers need to maintain some minimum amount of the account. Saving account provides automated teller machines, which is ATMs, that help savers to manage accounts such as deposit, withdrawal, fund transfer, payment, etc. Bank charges annual fees of ringgit on the ATM. The interest on saving account. Deposit is a component of liability in bank statement of financial position, as bank needs to pay interest on savings. Bank use deposit to provide funds to the borrowers by earning interest on loan. Interest on a saving account is calculated on the account's outstanding balance at the end of each day. The formula to calculate interest is principal, which is the balance, times by time, day, and times by the rate given by the bank. Second one is current account. The difference between current account and saving accounts. For current account, checks can be used for deposited and drawing money. A check can be transferred to another party without prior notice to the bank and is payable on demand. Another characteristic is interest is not paid for current accounts. Only commercial banks can offer current accounts. A current account holder can have an overdraft facility provided that he or she has prior agreement with the bank. Current accounts can be individual, joint, sole proprietor, company, and trustee account. To open an account, a customer is required to have an identity card or passport or memorandum and articles of association (MOA) and AOA for a company. To open a new current account, normally a bank would require an introducer and a minimum initial deposit. The third one is fixed deposit account, an investment or deposit account where funds placed with a bank for a period of time to earn interest as quoted by the bank, and depositors cannot withdraw the deposits until a specific maturity date. Depositors place a sum of money with a bank for a fixed period, for example 1 month, 2 months, 3 months, and up until 60 months, and earn a fixed interest rate. Fixed deposit account has a better returns than a saving account. The calculation for interest amount is principal times by rate times by time. And any premature withdrawal or upliftment before maturity date may cause depositors to forgo a portion of their interest as a penalty. Deposit certificate. Depositors are given certificate of deposits upon opening the account. If the depositor wants to renew or terminate the fixed deposit account, the depositor can notify the bank before the existing fixed deposit matures. If he or she does not notify the bank will automatically renew the fixed deposit account. And lastly is Negotiation Instrument of Deposit, NID. NID is introduced in Malaysia in 1979. Instrument issued by the bank certifying that a certain sum in deposits has been made for a certain tenure at a specific rate of interest. NID are deposits for fixed period that are negotiable and guaranteed by the bank. It can be sold in highly liquid secondary market before its maturity date if the needs for funds arise. However, they cannot be cashed and must hold until maturity for the new buyer who purchased these NIDs in secondary. NID can be issued with a minimum maturity of 1 month from the date of issue. The tenure may also be for odd number of days, for example 118 days. NID has a nominal value denominated in multiples of 50,000, which is the minimum amount, up to 10 million per certificate. No maximum amount of placement subjected to bank's account. NID often bought by large corporation institutional investors who usually invest in large denominations as a source to invest in a low risk and short tenor security. Next part is remittance. Remittance is a fund transfer where a sum of money is sent to someone for payment. It is a transfer of funds done in the banking system. It is provided by a commercial bank to its customers. In remittance, there is cashier's order, demand draft, telegraphic transfer, and online transfers. Cashier's order, also known as a banker's check. It is issued on behalf of bank customers. It is an order to bank to make payment on behalf of the customer to an identified payee in Malaysia. Cashier's order bears the authorized signature of the bank's officer. It is used when payment by personal check is not accepted or payment in cash is not advisable. Required documents for cashier's order is identity card or passport, account number such as savings or current accounts, and payee details. The cost incurred is check processing fee. For example, if 50 cents per check, stamp duty 15 cents, and commissions or survey charge 5 ringgit. Cashier's order only issued in Malaysian ringgit, but cashier's order can be deposited in any account maintained in Malaysia. The next one is demand draft. Cashier's order is used for remitting funds in the same area, but demand draft is used to remit funds to beneficiary who is at different area, town, or country. Demand draft can be deposited into the beneficiary's bank account or in cash over the bank's counters. The applicant for demand draft is all Malaysian citizens, permanent residents, and foreigners aged 18 years and above with valid identification credentials. For remittance amount of more than 10,000 ringgit or equivalents, need a supporting documents. The two types for demand draft is local and foreign demand draft. Local demand draft, drawn in a Malaysian ringgit and payable in Malaysia. The maturity of demand draft is 6 months. There are two types of local demand draft, which is outward and inward. For the outward demand draft, drawn to other banks branch. For example, CIMB Segamat drawn a demand draft to CIMB JB, and local inward demand draft issued by other branch on oneself. For example, CIMB Segamat received a demand draft drawn by CIMB Pulau Pinang. Foreign demand draft. Demand draft denominated in foreign currencies. There are also two types for foreign demand draft, which is outward and inward. For outward, drawn to banks overseas correspondent bank. The additional details needed is the amount, currency, and bank selling rate. For inward demand draft, issued by banks overseas correspondent banks, need to convert the foreign currency into Malaysian ringgit. Telegraphic transfers. It is a transfer of funds electronically using cable, telex, fax, telephone transmission, and through Society of Worldwide Interbank Financial Telecommunications, or SWIFT. It can be used domestically or internationally. The transfer does not use any signature test key. The authentication system is needed. Outward telegraphic transfers. It can be for in or out of country. Local outward telegraphic transfers can be made in Malaysian ringgit, but overseas transfer can be done in Malaysian ringgit or foreign currencies. The costs involved are amount to be remitted, cost of inland exchange for local telegraphic transfers, and transmission charge. If the telegraphic transfers is done in foreign currency, the Malaysian ringgit equivalent will be calculated at prevailing selling rate. Inward telegraphic transfers. It can be from in or out of the country, either from local branches, local agents, or from overseas branches or overseas agents. It is to remit the funds. The bank has to contact the beneficiary. If the inward telegraphic transfers is in foreign currency, the Malaysian ringgit equivalent is calculated at the buying rate. The last one is online transfers. It is fund transfer from one account to another via the online system. For example, internet banking, ATM, mobile banking, over the counter. Transfer funds within account maintained in the same banks or to other banks via interbank gyro and instant transfer (IBFT). Interbank gyro (IBG). MAPS Interbank Gyro is a network service between 21 participating banks that allow you to make transactions between your different bank accounts. It is convenient, secure, and cost-effective way that allows customers to move funds between different banks. It helps customers to transfer funds between on or third-party accounts for the purpose of normal fund transfers or payment of loans or credit card accounts and to others payee. The IBG system is managed by MyClear, a subsidiary of Bank Negara Malaysia. IBG Outward Fund Transfers. Outward payment allow you to transfer funds from your bank account into any of your accounts at participating IBG banks. For IBG Inward Fund Transfer, it allows you to transfer funds from any of your accounts at participating IBG banks to your account. Brandther system. It is a type of payment system, real-time electronic transfer of funds and securities. It replaced the SPID system for interbank payment and scriptless securities since 24th July 1999. The objective is to improve the overall efficiency of the large value payment system, particularly in respect of reducing interbank settlement risk. It enables payment instructions between the participants of the system to be processed and settled individually and continuously throughout the working day. Transactions performed by Rentas members via the system, interbank funds transfer, cash withdrawals from Bank Negara Malaysia, statutory reserve adjustment, money market settlement, ringgit leg of foreign exchange, scriptless securities transfers. Online transfers SWIFT. SWIFT is the Society for Worldwide Interbank Financial Telecommunication. It is a network that used by banks worldwide to send and receive information accurately, safely, and quickly about transactions on international money and security transfers. More than 10,000 financial institutions and corporations in 212 countries use SWIFT every day to exchange millions of standardized financial messages. The information and message are transferred via a standardized system of code, commonly called SWIFT code. It involves the secure exchange of proprietary data while ensuring its confidentiality and integrity.
Hi, a very good morning everyone. My name is Henrickson Jeremy and Ali, and today I will tell you about FIN435 chapter 8.3. Okay, so in this chapter 8.3, we will learn about credit facilities, and then overdraft, term loan, next is housing loan, personal loan, hire purchase, block discounting, leasing, factoring, and lastly the bridging and end financing, also trade finance. So without further ado, let's start. Okay, so everybody, what is credit facilities? Basically, credit facilities is an arrangement between a bank and a business that allows the business to borrow a particular amount of money for a different purpose in a particular period of time. Before a bank can lend out money, it needs to perform some investigations. These investigations are called credit analysis, also known as the credit analysis 5CS. So in this chart above is the recent credit analysis, which is the evolved credit analysis 5CS, which consists of character, capacity, collateral, capital, condition, collectivity, and capability. All of these are the evolved of credit analysis 5CS. So now let me explain one by one of the criteria. Okay, the first analysis is character. In this analysis associates with the quality in the borrower, which is judged based on the honesty, integrity, industry, and loyalty, and other factors of the client. So the bankers will have to look at the relationship of the customer with the bank. For example, looking at how is her business relation or reputation with the bank. Okay, and the second one is capacity. In capacity, the bank will look at the legal status of the borrower. For example, the legal age of the company incorporation. And the third one will be collateral. Collateral is an asset which the borrower uses to pledge as a security against the loan. For example, the asset that must be adequate and easily marketable could be house, land. Okay, next is capital. As for capital, the bank will look at the financial worth or the accumulated wealth of the borrower, and this can be ascertained by looking at the balance sheet of the borrower. Meanwhile, next is condition. Condition is related to the economic, political, and the global economic condition that may affect the borrower in paying the loan. And as for collectivity, it's concerning on how to collect or how to recover the amount borrowed or how easy it is to get back the money, which is in the worst case scenario, the borrower is unable to pay and declare bankruptcy. And lastly is capability. The capability is the ability of the borrower to pay the income, to pay to the bank. For example, this is done by the bank will examining the customer financial statements, salary, with academic occupation, and business. Okay, next is 8.3.2 subtopics, which is overdraft. An overdraft is an extension of credit from a lending institution that is granted when the account reaches zero. So the overdraft allows the account holder to continue withdrawing money even when the account has no fund in it. If overdrawn, daily interest will be charged on the outstanding balance at the end of each day, but it is only debited once a month. A commitment fee is charged on the unused amount, so that is overdraft. Okay, next, F.3 subtopic 3 is term loan. So term loan can be intermediate term or long-term loan. Normally, term loan are used to finance capital expenditure. For example, like to purchase fixed assets such as machinery and equipment. The interest on term loan is dependent on the repayment schedule. Interest is charged once or monthly if it is based on monthly repayment. For example, the interest is charged on the outstanding loan amount at the beginning of the month. Term loans are also known as NCGS, which is the New Principal Guarantee Scheme and is the main guarantee scheme of Credit Guarantee Corporation, which is CGC. Under this scheme, CGC provides a guarantee cover for loans ranging from 50,000 to 10 million to a small-scale enterprise. As for the next subtopic, which is chapter 8.3, on 4 subtopics, is housing loan. A housing loan is to finance the purchase of a house. The house purchase will then be used by the bank as a first legal charge for taking the loan. The maturity is usually between 10 to 15 years or even 25 years. BAM has issued a guidelines to commercial banks to ensure prospective house buyers costing 100 million or less to have access to the credit at a reasonable cost with 1.75% interest rate charged above the declared BLR or 9% or whichever is lower. So the margin of financing is usually 95% of the purchase price of the house based on its current market value. Meanwhile, as for personal loan, it's a loan that given to only individuals above 18 years old. This loan normally has a maturity between 6 months to 3 years or more. The loan is normally paid based on monthly installments. The bank needs to do the appraisal related to the character and financial standing of the applicant before approving the loan. For example, the information needed to be furnished by the potential borrowers are a 3-month worth of statement of income, which is payslips, and also the income tax assessment. Personal loans are usually range around between 5,000 to 200,000. And the next subtopic, which is 8.3.6, is hire purchase. Hire purchase is a contract or agreement where the agreement includes a letting of goods with an option to purchase and an agreement for the purchase of goods by installments. This includes the buying of private vehicles, private home appliances, business equipment, and business machinery. These agreements can be done in writing and must be signed by the hirer and the financier. The agreement would formally have the following information, which is the description of the goods and the specified time period, the number of installments and the time of payment, and the amount of installments, and specify the person to whom and the place at which the payments to be made, and also the address where the goods are located. And the others information would be the cash price for the goods and the higher purchase price, the deposit amount, and the statement of the parties' right, the right of the hirer to terminate the contract. A guarantor may be needed based on the higher credit assessment. And lastly is the insurance coverage throughout the duration of the higher purchase agreement. Okay, so how is the hire purchase transaction? The first one, the hirer would decide to purchase an asset, for example, car from a dealer. And second, the hirer will pays down the payment to the dealer. And then the third one, the hirer then negotiates the amount of financing with the financier. And the fourth, the financier then gives a letter of undertaking to the dealer in order to release the goods to the hirer. And fifth step, the dealer then delivers the goods to the hirer. And next, the financiers will pay the balance to the dealer. And lastly, the seller will need to pay the monthly installment to the financier. So this is the transaction of hire purchase. So in this hire purchase agreement, there is the right of the owner. So the right of owner is that he is to forfeit the deposit and to retain the installment already paid and recover the balance due, or to repossess the goods, and lastly is to claim wages for any loss suffered. So this is the right of the owner. Okay, so next we have subtopic 8.3.7, which is block discounting. So what is block discounting? Block discounting is the purchasing book debts, such as purchasing a series of hire purchase agreements, which is debt belonging to another finance company or dealer, and paying a lower interest rate to the finance company or dealer than the one specified in the agreement. So legally is the payment to the dealer of 100% of the book debt, which is residue and interest in the hire purchase agreement at a discounted rate under the contract. Next subtopic is leasing. So what is leasing? Leasing is a contractual arrangement between a lessor and a lease. So where the lease makes payment to the lessor for the use of the asset. These assets can run from 1 to 5 years but can go up to 60 or 99 years for the state of government property. Many people choose to lease. This is because the advantages of leasing is that it increases the purchasing power, because since there is no need to borrow in order to lease. Since leasing is not subjected to the market volatility and interest rate changes, so leasing offers a fixed rate of financing. Monthly installment can be negotiated in advance and fixed rates can be guaranteed for life of lease. Next advantage is that it conserves working capital because there is no need to pay for the expenses associated with the acquisition of the properties. It also provides the option of either return or extending the lease or purchasing the asset at the end of the lease period. But leasing also have its own disadvantages, which is there is no ownership. You cannot get the ownership because you are leasing, and rental payment for leases are a long-term expenses, which it could be more expensive than the price of purchasing the house, and the leaser may bear the cost of maintaining the assets. For example, like your house, your rental house. Yes. Okay, so we are still in leasing. So leasing, there are three types of leasing, which is the first one is financial capital. Oh no, sorry, pardon me, excuse me. It's financial lease, operating lease, and the third one is sales and lease back. So now, first I'll explain on financial lease and then operating lease. So let's look at the difference between financial lease and operating lease in order for us to understand it clearly. So I have construct a table for it in the next slide. So let's look at the difference. First, in terms of definition. So operating lease is a lease in which all risks and rewards related to the asset's ownership remains with the lessor. For the lease asset is called an operating lease. In this type of lease, the asset is returned by the lessor after using it for the agreed upon lease term. Meanwhile, as for financial lease, in a financial lease, the risks and rewards are related to the ownership of the asset being leased are transferred to the lessee. As for ownership, for operating lease, the ownership of the asset remains with the lessor for the entire lease period. As for financial lease, the ownership transfer option at the end of the lease period is available to the lessee. The title may or may not be transferred eventually. Now we look at the accounting effect. So in our operating lease, is generally treated like renting. That means the lease payments are treated as expenses and the asset does not show on the balance sheet. Meanwhile, for financial lease, it's generally treated like loan. Here, asset ownership is considered by the lessee, so the asset appears on the balance sheet. Okay, as for purchase option, for operating lease, the lessee does not have an option to buy the assets during the lease period. Meanwhile, as for financial lease, the financial lease allows the lessee to have a purchase option at less than the fair market value of the asset. As for the lease term for the operating lease, the lease term extends to less than 75% of the projected useful life of the lease asset. Meanwhile, for financial lease, the lease term is generally the substantial commit life of the asset lease. As for the expenses, The lessees pay only monthly lease payment in an operating lease. Meanwhile, in financial lease, the lessee bears the cost of insurance, maintenance, and taxes. And the aspect of difference from tax benefit is that operating lease have no depreciation to be claimed. Since an operating lease is as good as renting, the lease payment is considered as expenses. Meanwhile, for financial lease, the financial lease can claim both interest and depreciation, as financial lease is treated as a loan. As for the aspect of running costs in an operating lease, no running or administration costs are borne by the lease, including the registration, repairs, etc. Since this lease gives only the right to use the asset. Meanwhile, for financial lease, the running costs and administration expenses are higher and are borne by the lease. So, an examples of operating lease are the projectors, computers, laptops, coffee dispensers, etc. As for examples of financial lease are the plant and machinery, land, office, and building. As for the third type of leasing, which is the sales and leaseback. So this type of leasing is an arrangement that involving a seller selling the property to the buyer and the buyer leasing back the property to the seller. This allows the initial buyer to make full use of the property without having capital tied up in the assets, which is similar to financial lease. The owner of an asset sells it to another party and simultaneously leases it back to use it for a specific term. These assets are normally involved in buildings. Okay, the next topic is chapter 8.3.9 factoring. So what is factoring? Factoring is selling accounts receivable or debtors account to a factor company in order to finance a business. Factoring is also the sale of receivables invoiced at a discount, but at the same time is a borrowing where the receivable is used as collateral. Differ from a loan because it's involving selling of accounts receivable, and in a factoring transaction which involve three parties, which is the factor, seller of accounts receivable, and seller clients. Yes. So basically, factoring is a method used by a firm to obtain cash when the available cash balance held by the firm is insufficient to meet their current obligation. The use of factoring allows the firm to maintain a smaller ongoing cash balance. So by reducing the size of cash balance, more money is available for investment in the firm's growth. However, factoring is an expensive alternative and are normally considered as an option of the last resort. As you can see from the slides, this is the factoring process. So the first process is that the debt purchase facility is entered into between exporter and financier. In the second process, later the financier become a loss payee of credit insurance, and later the notice of assignments of debt to financier provides to the importer. And the fourth process is the goods are shipped and importer invoiced by exporter, and financial purchases invoice and pays 80% proceeds to the exporter. And lastly, the process, the importer will pay the invoice to the financier and exporter receives balance. And the last topic, chapter 8.3.10, is bridging loan and financing. Bridging loan or end financing is a short-term loan given to a housing developer in order to bridge the gap between immediate cash required, that is to start the housing project, and the anticipated cash to be received in the future. The bank will assess the financial standings and capacity of the developer before granting the loans. The bank also will need to conduct a comprehensive study on the feasibility and viability of the housing project before granting such loan. The loan is normally disbursed periodically according to the stages of the housing development. This type of loan is normally given by the bank to the same housing developer, and at the same time, the bank will provide a long-term loan to the individual house buyer. The proceeds received from the buyer will be used to settle the loan. So that is bridging loan. or N finance. As for trade finance represents the financial instruments and products that are used by companies to facilitate international trade and commerce. Trade finance made it possible and easier for importers and exporters to transact business through trade. Trade finance is an umbrella term meaning it covers many financial products that banks and companies utilize to make trade transactions feasible. So the first types of trade finance is letter of credit. Letter of credit is a document used to facilitate trade. They are divided into two types, which is revocable and irrevocable. Revocable line credits is a line is letter of credit that can be cancelled or amended by the issuing bank without prior notice to the beneficiary. A revocable letter of credit offers limited security, and because of this, the bank can hardly issue revocable letter of credit. Meanwhile, for irrevocable letter of credit, this is the reverse of revocable letter of credit. This letter of credit cannot be cancelled or amended without the consent of all parties concerned. And the second type of trade finance is banker's acceptance. Banker's acceptance is a bill of exchange drawn by customers to their order, payable on a specific future date, and accepted by the bank for the purpose of financing trade transactions. So the features of banker's acceptance, according to Maybank, that banker's acceptance finance both sales and purchases on the credit terms and have a competitive pricing, and the margin of advance is up to 100% of invoice value rounded downward to the nearest thousands. This banker's acceptance is a means of financing for working capital requirement and also the cheapest means of financing in Ringgit Malaysia that are currently available and also available in both conventional and Islamic bank, and require customers to have a facility with the bank, which are backed over by 400 branch nationwide and a network of over 80 international offices and 800 correspondent banks worldwide, according to Maybank. And the third types of trade finance is export credit financing, which is ECR. So ECR provides an alternative of a short-term, pre- and post-shipment financing to the direct or indirect exporters to promote export of manufactured products, agricultural products, and primary commodities. This type of trade finance is available to a manufacturer or trading company with ECR credit line duty established with any participating commercial bank. The pre-shipment of ECR facilitates the production of eligible goods for export prior to the shipment and to encourage the backward linkages between exporters and the local suppliers in the industrial development. The post-shipment ECR facility bridges the funding requirement of the exporter from shipment to receipt of payment of the export bill. And the fourth of trade finance is bank guarantee. This bank guarantee usually used to bid for tenders as a contract requirement or to guarantee payment obligations. This trade finance takes the form of a financial guarantee which ensures the fulfillment of financial obligation by you and a performance, and tender bond, which ensures the performance of an act agreed between you and the beneficiary. This can be issued to local parties as well as a foreign party and contains a specific validity period of coverage and claim period, and also available under Islamic financing as bank guarantee, and also available to customers with a trade facility or on an ad hoc basis. So the benefit of this trade finance bank guarantee is that it reflects on your capability to carry out payment obligations, and it also allows you to obtain favorable trade terms from the beneficiary if a bank guarantee is produced. So there is no necessity to rush cash to meet the deposit requirement, and funds could be used to support working capital requirements. And it also allows you to have access to funds, especially where a bank guarantee is issued for advance payment or for the release of retention funds under contract. So there are five types of bank guarantee, which is the tender guarantee, the performance guarantee, advance payment guarantee, warranty maintenance guarantee, and retention guarantee. So yes. And the last trade finance is shipping guarantee. So the features of shipping guarantee is that it is applicable for purchase of goods under the bank letters of credit or under inward bills for collection where the goods are consigned to the bank. Once the shipping guarantee is issued, the buyer is obligated to accept the document presented to him by the seller even if there is a discrepancy in the documents. For the purpose of issuance, only a copy of bill of lading and invoice are required. Also available under the Islamic finance as shipping guarantee and backed by over 400 branches nationwide, a network for over 80 international offices and more than 800 correspondent banks worldwide. And the benefit of the shipping guarantee is that it lets you clear goods without having to wait for a complete set of import documents, and it helps you to avoid any demurrage of other port charges and also improve your company cash flow. This is according to Maybank. A document issued by the bank to the shipping company that allows the importer to collect the goods from the shipping company is the essence of bill of lading. Is just in case you ask what is bill of lading. So that's all for me. I hope you guys learned something for my presentation on chapter 8.3 of chapter 8. Okay, that's all.
Hi everyone, my name is Mohd Yaziid and I'll be presenting on consumer product. There is 4 consumer product. The first one is ATM or automated teller machine, second is credit card, and then a debit card, and the last one is a charge card. The first consumer product is the ATM or automated teller machine, where there is an electronic banking outlet that allows customers to complete basic transactions such as a withdrawal of money or deposit money. We also can pay bills through this ATM machine. We also can check account balance and transfer funds to other accounts. The ATM card is installed with chip that contain information on card number. With the existing of this ATM machine, we can deal with the bank any time of the day without going to the bank, and this also reduces the bank workload. The second product is a credit card. It is an electronic card that is issued by the financial institution to the individual. The individual can make payment using this card, but it has a credit limit. Individual also required to pay annual fees and pay back the credit used along with interest charge. In order to get this credit card, you need to be at least 21 years old or 18 with the parent permission. Second, you have a source of income, and lastly, you have a positive credit history. There are advantages and disadvantages in using this credit card. The first advantage is convenience. You can use it anywhere. Second is you can purchase expensive item earlier since you have a credit card. Even though you don't have cash, you can swipe. And second is cutting down your debt. And the disadvantages is you may overspending if you're not able to control yourself using this credit card. And second, fraudulent card, where your card might be get stolen and used by someone else, and we are paying the fee and extra charges on the item that we purchase. The third product is a debit card, where this card is a payment card that can be used instead of cash when making purchases. Usually, this card giving along with other banking products such as new saving account, and when using this card, you need a sufficient amount of money in your saving account. And this card also have annual fee charges, and certain bank may give benefit or reward point by using this card. There are advantages and disadvantages in using this debit card. The first advantages is you can easily get cash, and second is you always within budget since you're using the money only in the saving account, and it take less time to purchase. The advantages are there are lower level of fraud protection, you don't improve your credit score, and some bank may charge extra fee for the annual fee charges. The last product is charge card, where facility offered to the customer to make payment without cash, or in other words, making payment in credit term. The bank or card issuer will pay to the machine on behalf of the cardholders and bill the cardholder later. The bill will include the interest charge via monthly installment, and this charge card falling out of popularity in recent years since other consumers prefer using credit card where there is a limit in using the card. Electronic data interchange is an electronic interchange of business information which allows one company to send information to another company. Business conducting business electronically is called trading partners. Documents can be exchanged, but most common are purchase order and invoice, which make possible a paperless exchange. EDI makes it possible to minimize the manual step involved. This illustration shows that how EDI improved the process by cutting down a few unnecessary processes and save more time and become more efficient.
My name is Brandther, and today I will talk about Internet banking. Internet banking allows a user to conduct financial transactions via the Internet, also known as online banking or web banking. Internet or online banking offers customers almost every service traditionally available through a local branch, including deposits, transfers, and online bill payments. Every banking institution has some form of online banking, available both on desktop versions and through mobile apps such as PBE, CAMB Clicks, and Maybank to You. Next is the features. First is non-transactional activities, which includes account balance viewing, viewing of previous bank's transactions, bank statement downloading, checkbook ordering, viewing of images of paid checks, m-banking and e-banking applications downloading, and provisions of account or bank statements. Next is transactional activities, which also includes electronic funds transfer, bill payments and wire transfers, loan application and repayments, and buying, investments, and products. Next is the advantages of Internet banking. Firstly, it is convenient. Basic banking transactions such as paying bills and transferring funds between accounts can easily be done 24 hours a day, 7 days a week, wherever a consumer wishes. Next is it is fast and efficient. Funds can be transferred between accounts almost instantly, especially if the two accounts are held at the same institution. And lastly is consumers can monitor their account regularly. Around-the-clock access to banking information provides early detection of fraudulent activities, thereby acting as a guardrail against financial damage or loss.
Next is disadvantages of internet banking. Firstly is safety. Although online banking security is continually improving, such accounts are still vulnerable when it comes to hacking. Next is internet connection. Connectivity issues from time to time may make it difficult to determine if banking transactions have been successfully processed. And lastly is potential to overspend. The ability to check account balances in the spur of the moment could potentially cause some people to overspend the limits of their checking accounts. Mobile banking is a system that allows customers of a financial institution to conduct a number of financial transactions through a mobile device such as a phone or personal digital assistant. The earliest mobile banking services were offered over SMS, a service known as SMS banking, with the introduction of smartphones with WAP support enabling the use of the mobile web in 1999. The first European bank started to offer mobile banking on this platform to their customers. Mobile banking has until recently most often been performed via SMS or the mobile web. Apple's initial success with iPhone and the rapid growth of phones based on Google's Android have led to increasing use of special client programs called applications or apps downloaded to the mobile device. Mobile banking services. Firstly is account information, which includes mini statements and checking of account history, alerts on account activity or passing of set thresholds, monitoring of term deposits, access to loan statements and card statements, mutual funds or equity statements, and insurance policy management. Next is payments, deposit, withdrawals, and transfers, which includes cash-in, cash-out transactions on an ATM, domestic and international fund transfers, micro-payment handling, mobile and direct-to-home package recharging, purchasing tickets for travel and entertainment, bill payment processing, withdrawal at banking agent, and deposit at banking agent. Lastly is phone banking. Telephone banking became available in the 1980s, first introduced by Eurobank in the United Kingdom, which established a dedicated telephone banking service in 1994. A service provided by a bank or other financial institution that enables customers to perform over the telephone a range of financial transactions which do not involve for cash or documents, such as checks, without the need to visit a bank branch or ATM. The types of financial transactions which customers may transact through telephone banking include obtaining account balances and lists of latest transactions, electronic bill payments, and fund transfers between a customer's or to another's account. However, the use of telephone banking services has been declining in favor of internet banking since internet banking became available in the early 2000s and further eroded with the advent of mobile banking in the 2010s.